Hi, everybody. Today I would like to speak about measures in finance. What do you mean? What do we mean with measure? How we can use them, and explain with different, very simple examples how we can change from one measure to the other. So let's start it. In the world of finance, we often navigate between two perspectives: the real world, where assets have varying risk premiums, and the risk-neutral world, where all assets grow at risk-free rate. The shift in perspective, known as changing measures, is crucial for effective risk management and derivative pricing. You see here a couple of examples which explain what we can do under the assumption of the real world measure. Like, for example, we forecast pricing, how the prices will develop in the future based on the historical returns, because we don't know how the prices will be in the future, but based on our expectation, we can forecast the future prices. We are required to do this when we do some kind of reports under or banks have to do under Basel III requirements. We need we work with the real world measure under the assumption of risk for risk assessment and management, for portfolio optimization. But the most important example for option for risk neutral measure is option pricing. When we assume how we want to price our options, we assume the risk-free world. Let's explain what these two assumptions mean, and then I will show a simple example. The risk-neutral world is a theoretical model where all assets are assumed to have an expected return equal to the risk-free rate. In this model, the risk premium do not exist. Future cash flows are discounted at the risk-free rate, and since assets are assumed to grow at this rate, discounting future cash flows results in the current spot price, what creates a martingale process. This means the assumed future price after discounting is equal to today's spot price. The risk-neutral world is also referred to as the measure Q. Measure in this context means probability distribution. In the probability theory and financial mathematics, a measure refers to a way of assigning probabilities to events. In contrast, the real world measure, or measure P, is based on historical data rather than on an assumption of risk-free rate. Here, an asset's current value is the sum of expected future cash flows discounted at the rates reflecting the asset's risk. Through the discounting with appropriate rates, when we speak about future, we don't know them, but as we speak about the past, we can find out the appropriate rates, which and these rates include the risk premium. The discounting leads also to the spot price, and we have also a martingale process. The assumption of different growth rates generates or creates different probabilities for the same stock prices. Q-word is especially used for pricing of derivatives, and P-word for analyzing past data and preparing basis for forecast, portfolio selection, and allocation. One general word: martingales and measures are fundamental to understanding risk-neutral valuation in financial mathematics. A martingale is a stochastic process with zero drift, implying that the best prediction of the security's future price is the current price, given all the available information. In this context, A measure refers to a probability distribution used to evaluate security prices in and their expected values. Yeah, let's clarify this with a simple example. We use as the example Black-Scholes model. Under Black-Scholes model, we have the stochastic differential equation. When we apply a special process, which I describe in one of my LinkedIn articles, we can show how from this equation we are coming to the next equation, and then we can apply this equation once in the real world and once in the risk neutral world. You see the differences between risk free and risk free and real world. The difference is trend risk rate. In the real world, we assume that the assets will grow on average with the trend, and in the risk neutral world, they will grow when they will grow with risk free rate. Now, I am attaching to this presentation also the spreadsheet, so you can analyze this according to your as fast as you want, and you can see all the formulas which are included, and based on the calculation what we have here created, and with help of in this equation we can simulate uh, uh, the exchange, the stock prices, and we can then uh, analyze the impact, how this may can develop according to various assumptions, and the risk according to the risk which we express with help of the in Excel with the rand function which calculates uh, uh, random numbers from 0 to 1, and using another Excel function we can uh, show this process according to the real world assumption and risk neutral world uh, using Excel formulas. And what we have once when you what we have done, we have generate a trend. Okay, we have assumed that in this case the trend is 11% is 11%. Yes, I am right, 11%. And we have the uh, oh, you see volatility. I use just 3% because otherwise, if I take regular 20%, then the graph which I create will look for a year totally. You will see I can change this to 20, and you see it's not visible what is happening. So when I play with 3%, uh, we can uh, see easier on the graphic. So on the graphic we have once we have the trend with 11%, we have the trajectory of a risk-free rate of 5%, and then we have in the real world we have the Brownian motion and we have the trend, and this green shows how the stock prices will develop in the real world. Now we have in blue, this is the risk-free world. You see the different trends, but the unknown factors which create this Brownian motion are the same in these two processes. And if you knew for the real world what you know for the past, the trend, and discount this trajectory with the appropriate rates, you obtain martingale process. See that these two trajectories of real world and risk-free rate. After applying the appropriate discount factor for real world trend, for risk-free rate, for risk-free world, uh, risk-free rate, we are coming to the same trajectory. It is a little bit, you see this two different because I have created, in order to make it visible, I multiply the risk-free word with the factor of 1.002 to be able to show that we have this trajectory is showing two Brownian motions. Yeah. So this is the first example. Now will go to the next example. What is very interesting about this model, uh, that with help of the random Nicodim derivative, we can transform from one word into the other. We can have calculate something under the assumption from real world, and then we can move this into the other world. And I can also show here how we can exchange the formula that it works under the real world, and then it exactly changes into the formula with the risk-free word. You see here it is a formula which we use to calculate prices under the real world. We multiply and this the random Nicodim derivative tells us that we have to adjust this formula by this factor in order to switch from real world to risk-free world. If we do this, and then I'm trying to show that I can get exactly the formula for the risk-free world, I just am taking this factor from for the brackets, and then it looks like two factors which partly cancels out. And if I go to the next step um, and regroup this formula, you see the result is risk-free world. And now I can also show this with the real numbers. I calculated according to real world assumptions. They are the rates which we achieve. We achieve the rates with the risk neutral word. Of course, they are different. Yeah? But when I when I take the words uh, from the real world and subtract this term as it according to uh, random Nicodim derivative, I am obtaining, I have to take care, I am obtaining exactly the same, the same results as I am obtaining when I calculate directly risk neutral calculation. It is amazing how you can switch from one word to the other with the help of the random Nicodim derivative, or you can do this similar calculation uh, when you apply the Black-Scholes formula. Black-Scholes formula tells us how to calculate the premiums, and we calculate the premium as we normally do under the risk-free world. It is what would come out as the risk premium under the real world, but we can also, if we use now Girsamov theorem, we just adjust by the Girsamov theorem, and we obtain exactly the same rates in the real world as the risk. Okay, it is not the real world now. It is the adjusted real world uh, with Gersam theorem, trying to show that these processes are related. You can, in principle, change from one mode to the other if it is necessary for your calculation, and you are still working with a process which is explicable. And of course, what Black-Scholes model using the risk neutral word, it is the right way to look at the option pricing, but you see that you could also adjust real world. If you apply Gersam theorem, you get exactly the same results. You have to make a adjustment uh, by uh, um, market by market risk. And what I wanted to show you, that you have the normal regular formula how to calculate call option premium. Then you have what you normally use. You calculate D1 and D2. It has the formula for D1. Just look at the interest-free rate. And when we switch to when we switch to when we switch to real world instead of R, we have a trend, mu, or variable, how we describe this. And now we can, applying Gersam theorem allows us to move from the real world measure with drift me to the risk neutral measure with drift R, by accounting for the market price of risk. And we define market price of risk, which is the same as Sharpe ratio, as lambda trend minus risk-free rate divided by standard deviation. What we have to keep in mind, that in our formula, this is the formula for periods not necessarily 1 year, but for any possible time. This is market price of risk also without taking time into account, or time as 1 year. If we work with the time which is different than 1 year, we have to take into account that standard deviation is proportional not to time but to the square root of time, and then we have to adjust this market price of risk formula. And now we subtract D1 with trend. We subtract now market price of risk, and with some simple changes, since here denominator, we can put this on the one denominator, then we have very simple, or it looks simpler. And then we make the adjustment that me disappears, and we are coming after the simplification. We are coming to exactly the same regular D1 formula. So I'm just showing that you have big connection between these two worlds. If you apply Gersam theorem, or you apply random Nikodym derivative, you can implement these changes, or the journey from one world to the other. But most important thing, within two different words, we have the different probabilities. If you have the measures, for example, the probability under, it is the best when I explain this with the example. No. If we have the probability trend of 11% and the trend of risk-free rate of 5%, it is, for example, the probability under the real world that the prices will be higher, let's say, than 110, is substantially bigger than the same probability that the prices will be higher, for example, than 110 under the risk-free world. See, these different trends leads to different probabilities, and this has to be taken into account. Understanding how to shift between measures using the Girsanov theorem or random Nikodym derivative opens the door to exploring both the real world and the risk-free probability frameworks. While it is possible to calculate option prices under the real-world assumptions, the probabilities that govern the real world differ fundamentally from those in the risk-free world. The risk-free measure isn't just a convenient choice; it is a fundamental foundation for derivative pricing models like Black-Scholes or binomial models under Cox, Ross, Rubinstein, or Yarrow-Root frameworks. In the spreadsheet where which link I have provided, you can see how these principles come together to ensure arbitrage-free pricing. Dynamic delta hedging provides a practical way to maintain a hedged position. In my YouTube video, Testing Dynamic Delta Hedging with Monte Carlo Simulation in Excel, I share the results of billions of simulations, demonstrating that delta hedging based on ND1 is both effective and consistent with arbitrage-free strategies. Thank you for engaging with this material. I hope it inspires deeper exploration into fascinating interplay between probabilities, hedging, and pricing. Thank you.